Okay. Thank you for joining our fireside chat today. For those that are joining us from the live stream, I'm Emily Greenwald, and I'm the head of banking supervision and regulation for the Federal Reserve Bank of Dallas. And I also lead our credit risk and reserve management department, which includes the discount window. I'm honored to introduce Michael Barr, who took office as the Vice Chair of Supervision of the Board of Governors of the Federal Reserve System on July 19th, 2022, for a 4-year term. He also serves as a member of the Board of Governors for an unexpired term ending in January of 2032. Prior to his appointment to the Federal Reserve, Vice Chair Barr was the Dean of the Gerald Ford School of Public Policy, the Frank Murphy Collegiate Professor of Public Policy, the Roy Jean Humphrey Profit Professor of Law at the University of Michigan Law School, and the founder and faculty director of the University of Michigan Center on Finance, Law, and Policy. At the University of Michigan Law School, Vice Chair Barr taught financial regulation and international finance, and he co-founded the International Transactions Clinic and the Detroit Neighborhood Entrepreneurs Project. So he's got a lot of different experiences that he brings to the table that we are very thankful for. He also served as the U.S. Department of Treasury's Assistant Secretary for Financial Institutions. And under President Bill Clinton, he served as the Treasury Secretary's Special Assistant, as Deputy Assistant Secretary of the Treasury, and as Special Advisor to the President. So with that introduction, I am very pleased and want to thank Vice Chair Barr for joining me today in a fireside chat in Dallas in May, where we probably don't have actually a fireplace, as you can see, because it's quite toasty here. But we are delighted and thrilled to have you at our event today, and we thank you in advance for your candid conversation that we're going to have. I have a few questions that we're going to kind of talk through, but then we're also going to have an opportunity for the audience here in Dallas at the Federal Reserve Bank of Dallas for folks in the audience to also ask questions. So as we're going through today, feel free, all of you, to think about those questions you may want to ask. So I wanted to sort of kick off our time today sort of by having an opportunity for you to share your current outlook on the economy and how that intersects with the banking industry.
Well, thank you, Emily, for having me here. Thank you to Lori Logan, President Logan, for having me here. I'm just delighted to be able to join all of you here in Dallas, even in May. If we were in Michigan, we might be talking about hail in May.
That's true.
So a little heat doesn't bother me too much. It's just great to be here. Let me just say, broadly speaking, on the economy, overall, the economy is quite strong. We have really low unemployment under 4%. And we've had that low unemployment now for 27 months in a row, which I think it has not been the case for at least 50 years, that long extent of low unemployment. So that's very positive. We've had solid growth over the last number of years. The big issue for us, of course, is inflation. I take both sides of our mandate very seriously, both the stable price side of the mandate and the full employment side of the mandate. On inflation, we've seen a lot of progress. So we've moved from 7.1% inflation on a PCE basis, headline, 7.1% inflation a couple of years ago now to 2.7%. That's enormous progress, but we still need to finish the job, and we need to get all the way back down to 2%. We had last year 7 months in a row of encouraging inflation readings, but the first quarter of this year we had more elevated inflation readings, and that did not provide me with the comfort that I was hoping for in that first quarter. So for me, at least, that means that we need to sit tight where we are for longer than we had previously thought. And I think we're in a good place to do that. I think policy is restrictive. It's having its effect on the economy, but we need to see more evidence of continued progress on inflation for us to be in a position where we could think about adjusting the policy rate. What does that mean for banks? And for banks in the regional and community bank space? First of all, some banks have elevated interest rate risk, and that elevated interest rate risk will continue and needs to be managed prudently by the banking sector. It also means that on the liquidity side, on the deposit raising side, deposit betas may continue to be higher, and that is expected at any point in as you move along the point in the cycle. So, managing liquidity risk, interest rate risk, and funding costs, I think, are going to be challenging. And I'm sure we'll talk about this later, but it also has implications for the commercial real estate market. And so, banks that are exposed to commercial real estate, there are really two sides of this that people are worried about. One is vacancy rates, given the persistence of work from home in downtown office space, higher vacancy rates, and also the repricing risk as properties move from a very low rate environment to an elevated rate environment. There is the difficulty that those deals will no longer pencil out. And so I expect that banks are going to have to navigate both those kinds of risks going forward.
Thank you for that. And it's definitely a challenging arena to be in, but at the same time, that dual mandate's really important in thinking about how do we balance that, those inflation numbers that keep popping up, not exactly to where we need it for that soft landing, but we're still hopeful.
We're at it.
We're at it, yes. So I want to switch gears a little bit and kind of get your thoughts. You certainly, I'm sure, have some on the events that happened in March of 2023. Most of our audience in the room here in Dallas are regional banks, and that the events surrounding Silicon Valley Bank had sort of an unprecedented and outsized impact on our regional banking organizations. But I wanted to sort of start with how your view on liquidity has changed over the last year, if at all, from all of those events.
Which it's a great question. We saw, and I know you all know this, we saw unprecedented speed of deposit outflows from the institutions that failed, but also other institutions saw significant funding pressure at that time. At SVB, they were lined up to lose about 85% of their deposits the morning that they failed on Friday. They basically failed in an afternoon. And so that speed of deposit run, I think, is something we all need to take into account in thinking about liquidity risk. And one of the things that we saw as SVB was failing, and then Signature and First Republic came under pressure, that there were many other institutions around the country that weekend that were letting us know that they were coming under pressure, or they were worried that they were going to come under pressure. And that's why we ended up invoking the systemic risk exception with the FDIC and recommending that to the Treasury Secretary, and the Treasury Secretary invoking that, and why we established on an emergency basis the Bank Term Funding Program to provide access essentially to the discount window, but providing that at a term of 1 year and at par on securities. And those measures calmed things a lot. We saw some continued deposit outflows, but those significantly slowed when people understood the nature and the presence of these emergency programs. Things calmed down. But it did cause a lot of liquidity issues for regional and some community banks. And those liquidity pressures also translated into having to pay up for deposits. And so that creates its own, imbalance in terms of having to manage, net interest margins with potentially higher deposit betas for some institutions and securities on their books that are, below value on a market basis. So, one thing we learned is that, first of all, there can be contagion in the banking system, even from institutions that are not designated as systemically important, which was a tough lesson. We learned that deposit flows can be much faster than people thought before. Some of that has to do with social media and technology, but It's also just the structure of the way uninsured deposits are being used in the system, or for some depositors and for some banks, and also the network effects among depositors can also be a problem. If you have highly interconnected depositors, they can all decide, in effect, to run at the same time. So we're looking at all those issues. I gave a speech yesterday. I mentioned that we're looking at some targeted changes to our liquidity rules as a result of the stress events in March. And we're looking primarily in three areas. One of them is about discount window preparedness. So we saw last spring that some banks, including some very large banks, were unprepared to use the discount window. They hadn't tested, or they hadn't tested in a long time, at very low levels of pledging in advance, which is really a problem. They had operational challenges in moving collateral. They had difficulties understanding where their collateral was. So there are lots of issues on the bank side in discount window preparedness. So we're looking at a requirement that banks above a certain size pre-pledge assets collateral to the discount window as a proportion, not all, but as a proportion to their uninsured deposits, and regularly test. The second area that we're looking at is about the way in which banks assumed that held to maturity securities could be repoed in order to monetize them in a crisis. And one of the things that we saw is that the banks that were under stress had difficulty monetizing their held to maturity securities. And so we want banks to, if held to maturity securities are part of your contingency funding plan, repoing them is, we want to make sure that banks actually can repo and repo in the size that they think. And there may need to be limitations on the assumptions that go into that. And then the third area we're looking at has to do with deposit outflow assumptions. And we're looking in a targeted way at whether deposit outflow assumptions should be updated for high net worth individuals, for venture capital funds, for crypto companies, because the deposit flows we saw from those sectors were much faster than anticipated in advance. So we're looking at all those areas, and then also we're looking, inwardly at ourselves and asking, are our discount window operations sufficiently modernized? And so we're going to do work. We are doing work internally in the Federal Reserve System to make sure that the discount window is operating from a technology and from an operations perspective at the highest level.
Thanks for that. And I had a chance to read your speech yesterday, and the discount window piece as well really fits nicely into President Logan's remarks that she's been very much an advocate of the discount window and thinking about how we can reduce that stigma and also getting all banks signed up. I think I have a goal to try and get 100% of all the depository institutions in the 11th district signed up.
Maybe we'll have a little competition.
I'm on the way. Exactly. I would love to see my district be the first, to get to full 100%. Doesn't matter your size, the importance of that funding capacity. You mentioned, uninsured deposits, and I wanted to get a little bit of your views on, knowing what we know now about some of that deposit outflow and in 2023, and thinking about banks that specialize in commercial credit. They oftentimes have commercial customers, and those sometimes can make up a high proportion of their uninsured deposits. So wanted to get your views on sort of, how banks should navigate sort of concentrations in uninsured deposits.
Well, thanks, Emily. So let me say, maybe on both the asset and liability side of the balance sheet, there are issues with that concentration. But on the liability side, it's really, really important to make sure that you understand who your customers are. I'm not saying anything brilliant. You need to know who your depositors are and make sure that your deposit models are accurately reflecting potential flows from those customers. All uninsured depositors are not the same. There's a wide range of uninsured depositors out there. They're banking with each bank for different reasons. So making sure that you understand the depositor profile and that your models reflect your understanding, that your data and systems are sufficient to capture the information you need in order to make those judgments, and that you're managing your liquidity risk appropriately to your risk profile. On the asset side of the balance sheet, of course, if you're concentrated in commercial real estate, uh, you might have a combination of factors that present special risks that you need to manage for. So on the commercial real estate side, drilling down property by property to make sure that your provisioning is the right level of provisioning. Not all commercial real estate is the same. There's lots of heterogeneity around the country in performance of commercial real estate. Each asset class performs a little bit differently. Even within an asset class, we've seen that, if you're doing office commercial real estate in the downtown, that's different from in a suburb. Even in a downtown, your A class buildings are different often from your B and C class buildings. So just a really detailed look, a really hard look, a really searching look to make sure that provisioning is appropriate for that risk. And we do have some banks that have not only uninsured deposit exposure and a commercial real estate exposure, but also have significant unrealized losses on their balance sheets from securities because of interest rate risk. And if you have all three of those kinds of concerns, really, that your risk profile goes up a lot. You really have to make sure that you're conserving capital or raising capital and managing that liquidity risk really tightly. And for all these things, I'd also say it's really important that management is keeping the board informed of these risks and making sure that the board can appropriately engage on these topics, because it's just critical in some cases, to the survival of the firm, but certainly even in less acute cases, to the health of the firm.
That's a really good point, and something that as supervisors we've really noticed is the engagement of your board when you're faced with any of these headwinds is really, really critical to navigating them as you're going forward. We've spent some time on liquidity. I wanted to also make sure we spent some time on another one of your favorite topics, which is capital. You mentioned it just a moment ago, and you also spoke about this yesterday. But we've come out with some proposals on capital, and I wanted to get sort of your thoughts on how sort of we're thinking about the proposed Basel capital rules. There's been a lot of strong opinions out there.
I have seen
in the public. I'm sure some of you in the audience have your own opinions on it. And what I wanted to maybe tease out is sort of what is important for bankers to know about sort of both the goal in that space and also how we approach the rulemaking process, because I think that's an important process that we go through when we have these types of changes.
So capital, again, to state the obvious, capital is absolutely critical to the health of any banking organization and to the health of our financial system. Capital is the cushion that enables banks to suffer losses and still go on to serve customers, counterparties, the economy more broadly. So capital is the means by which banks make loans. There's sometimes confusion in the public eye. People say capital is on the sideline. No, capital is not on the sideline. Capital is what enables banks to be good lenders and good providers of services in their communities. So capital is critical. What did we do in our proposal? Our proposal is about large banks. So banks over $100 billion in size. There are under 40 of those institutions. There are more than 4,000 banks in the country. So the capital proposal applies to the largest 1%, less than 1% of banks in the country. And what it does is it tries to update the rules coming out of the global financial crisis to better reflect risk, to make sure that our risk-weighted asset approach to capital better reflects those risks. And we looked at changes in operational risk, credit risk, and market risk. One of the changes we suggested is directly related to the stress of the spring, and that is that large banks should flow through into capital their unrealized losses, so that interest rate risk is better managed in advance, and so that if there are problems, capital is automatically required to be injected into the bank to keep it safe and sound. So we've proposed these rules. A proposal is not the same as a final rule in our system.
Right.
So, and that's good. We have a process in the United States that I'm very proud of, which is the notice and comment rulemaking process under the Administrative Procedure Act. And that requires us to put out a proposal for comment. We get comments from the public. We had a lot of comments on this proposal. And they were good and substantive, thoughtful comments. They were different from the public rhetoric, which is not that helpful. But the actual comments we got in the notice and comment rulemaking process were very helpful and thoughtful and substantive, as were many conversations we had with bankers all over the country. I expect that we're going to make some substantial material changes to the proposal before we go to final in operational risk, credit risk, and market risk. We want to get it right. We want to make sure it's calibrated right, and that's the process we're going through now.
Super helpful to get some insights into that, and I think it's also really important that individuals understand that those comments come in, they matter, and we really do respond to each of them. I had an opportunity in the Great Financial Crisis to be a part of some of those proposals, and went through a lot of details on comments for that. So we appreciate it, and it is very, very helpful. But regardless of where the proposed capital rules land, investors in 2023, especially around the regional banking organizations, really tend to focus on simple metrics like tangible equity and evaluating strengths of companies in sort of a really quick fashion. So how should supervisors and bankers think about our regulatory framework of capital, but then also, tangible equity, or how some of those pieces kind of fall into their capital planning?
Well, our regulatory rules are designed to be a basic framework. They're kind of a floor under the risk measurement and risk management practices at banks. But we expect banks and bank boards and supervisors to look at other measures of risk too, and obviously banks do. And if the market is looking very intently at you because of tangible common equity, for sure you're focused on tangible common equity as a measure. We also look at market adjusted tangible common equity as a tool to look at the safety of the system, where we can adjust for the changes in the asset side of the balance sheet. We also look at deposit franchise value, the liquidity, the liability side of the balance sheet, because obviously if you're operating in an environment where you're able to hang on to deposits and your deposit beta is any number less than 1, then you have deposit franchise value that also the market should take into account in thinking about the health of the bank. So I think it's really important in these kinds of circumstances for market observers and bankers and boards and supervisors to think about the balance sheet as a whole and make sure that banks are managing those risks as a whole. And the risk profile of each institution will be different. We want to make sure that bankers are attentive to those kinds of differences.
Thank you for that. And so sort of switching gears now to supervisors, and kind of, as you've publicly noted and talked about, you've been very transparent in sort of the lessons that we've learned as supervisors through 2023. And you've done several things to really improve supervision. And included in that is sort of the idea of sort of speed, force, and agility. And that we need to sort of flex our approach when we're on a job supervising. So can you elaborate on what sort of bankers should be expecting as a result of speed, force, and agility in supervision?
Thanks, Emily. So, one of the things that we did right after SVB failed is I thought it was really important for us to do an honest, forthright, transparent, and critical self-assessment of supervision. And so we issued a report just a number of weeks after SVB's failure that laid out areas where we could have done a lot better. And one of the areas that I think is really important is making sure that we empower supervisors to act with the speed, force, and agility that is appropriate for the particular risks that a bank is facing. You don't always need speed, force, and agility in supervision. But when you have an important risk that is also an urgent risk, we want to make sure that supervisors are empowered to take the steps they need. Part of that is setting the right tone from the top. Part of that is about making sure supervisors have the tools that they need to act. Part of that is about making sure our escalation framework is appropriate to the risks facing an institution. So we're doing work internally at the board and with our colleagues in reserve banks to make sure that we have that system right. And if it's working right, then a bank that has a higher risk profile should feel like they are getting the attention that they deserve. And a bank that has a lower risk profile should not feel any change. So that's the way to think about it.
Yep. No, I think that's helpful. And it's also, as we go through those lived experiences, we often remind our bankers that we do have a shared goal of really having safe and sound and resilient banks. And so part of that is to have speed, force, and agility where appropriate, to making sure that we continue to be successful in that realm. I'm going to ask a couple more questions, and then I think it'll be time for us to turn it over to the audience. But one of the other pieces that we actually have as part of our conference agenda later on is we're going to be talking about, regional banks as they sort of transition into large bank supervision. So I'm excited that we have actually a breakout session for some of our regional banks that may be crossing that threshold sometime in the next few years. And so can you let us know, sort of at a high level, what you're looking at in terms of ways to better prepare regional banks for that less than 1% that you noted at the top, but we do see some growth in some of those larger regionals.
So let me just start by saying I think that one of the amazing things, one of the great things about the U.S. financial system is we have institutions of all different sizes and types in our economy. I think it serves the U.S. economy well. We have thousands of community banks. We have hundreds of regional banks of all sizes. We have some very large banks that are not yet thought of as globally systemically important. We have the GSIBs. That diversity of kinds and types and sizes of institutions serves our economy really well. And so we want to make sure that the steps that we take are supportive of those institutions thriving. One of the things that we saw and have seen over the last couple of years is that it's not always the case that our supervision has appropriately grown with the risk and size of an institution. And it hasn't always been the case that banks that we supervise have adjusted their risk management practices, their IT systems, their board oversight, and the like, commensurate with their change in size and risk. And so we want to make sure that those things go together. That is, institutions are growing or changing in some material way, that our supervision is changing, and that the boards and that the bank's risk management practices are also appropriately changing. We don't want to see cliff effects where an institution is kind of humming along at one level of risk measurement and management, gets to be a large bank, and then the expectations are up here. And we say, where's your risk management? And the bank says, well, we were a small bank before. That doesn't help either the bank or supervisors be effective. So we want to make sure that as banks are growing, that their risk measurement practices, their risk management practices, their internal infrastructure, IT issues, their systems, their boards are growing in their sophistication with the growth of the firm.
Thank you for that. And one final question on the banking related topics. The Federal Reserve has a novel banking program now. Some banks, you sort of move into that space either, through some of their business lines or non-traditional products. What's your thoughts on novel activity and banking as a service and fintech relationships as you see them today?
It's a great question. There's a lot of innovation happening in the banking system, and that is terrific. We like to see banks engage with financial innovation in a way that will help them better serve their customers, the businesses, their households, or their counterparties. And that kind of financial innovation can be especially helpful in staying competitive in improving efficiencies and improving access and outreach. But we need to make sure that it's done in a way that is within guardrails, so that we protect consumers and we protect the financial system from risk. And so we set up this novel activities group to help our supervisors on the front line and the banks they work with better understand those risks and manage them. And I think it's worked well so far. Those teams have been really helpful in working with banks that are involved in novel forms of banking as a service or engaged with the crypto sector. When banks do that, we want to make sure they have the risk management in place in advance of getting involved, not afterwards. We have a number of banks that manage these risks really well, banks of all sizes. But we have some banks that didn't put in place the right risk management structures in advance and got themselves into real trouble. And so we don't want to see that either. No. We want financial innovation within these guardrails.
Yep. Responsible financial innovation is really the way to go, and I think what we're emphasizing there. So it looks like we're now at the time period where all of you get to ask questions within the audience. Please do make sure that you use your microphones and press the button that provides it to be on, so that those on the live stream can also hear your question as you provide it. Sure, go ahead.
You weaved a couple of comments regarding uninsured deposits, and that was one of the challenges with some of the bank failures last year. We know that any changes to the FDIC setup is going to require a political process. I'm curious what you think would be maybe a good outcome for FDIC insurance, and also what we should be doing as an industry to maybe influence how that outcome looks when it gets finished.
As you said, the FDIC insurance levels are a matter for Congress, not for the Federal Reserve or for the FDIC. I would say that it's important that as Congress considers anything in this realm, that they hear appropriately from people with expertise in that matter. So if it's an area that you want to get engaged in, I think that kind of comment is always welcomed by Congress in thinking about the issues. I don't have the sense that Congress is, at the edge of its seat, ready to pass some change in deposit insurance. So that's not an area that seems to have galvanized people in Congress right now.
I will also put in a plug for an upcoming conference we're hosting here at the Federal Reserve Bank of Dallas in July called Conventional Funding in an Unconventional World. And so we're going to be exploring from a research perspective. Our research department is putting this on some of those topics, along with a variety of others that might be helpful as people really think through that perspective.
Vice Chair Barr, a related question to Steve's. I think one of the tools that worked really well during the great financial crisis was the transaction account guarantee program. And I know Congress took that away from the regulators as part of Dodd-Frank. And I just have to believe if that would have been available in March of 2023, it would have been a huge stabilizing factor. And so what's your reaction to us, and I'm not asking for you to say, go do it. What's your reaction to us asking for that to be put back in the hands of the regulators with the requirement that we go back to Congress, or you guys go back to Congress if you invoke it to explain the reason you used it?
Thank you. It's a great question. And I do think that had we had that tool available to us, it would have been quite helpful in reducing stress in the banking system last March. We ended up using a combination of these other two tools that I think also was quite effective in stopping the bank run in the banking system, which I think was really critical to stability for the regional banking sector and for others. it is a matter for Congress to take up. Again, like deposit insurance reform, I haven't seen any inkling that this is top of mind in Congress right now. And so we sort of use the tools that we have according to the existing law.
Another tool that seemed to stabilize deposits are the use of reciprocal deposits. We do know that above a certain dollar amount, they're considered brokered. And again, that's a rule that can't be changed at this point without action. When you look at the liquidity requirements coming up and the different outflow assumptions, how do you look at those deposits?
That's a great question. So in general, the process that you all use to exchange deposits with one another increases the level of insured deposits in the system. That is one metric overall that we use to look at the overall safety of the system. And so it has been effective since March of 2023 in reducing people's level of concern about deposits in the system. I do think it's important as we develop liquidity requirements that we understand the mechanism that's being deployed, and that goes into our thinking overall about the calibration of our liquidity requirements. So it is part of our thinking about it.
So other side of the balance sheet, you talked a little bit about provisioning and commercial real estate loans, diving deep. Talk a little bit more about what does that look like?
Well, it's the normal business of banking. So I'm really just emphasizing that taking a good hard look, even if you think that your provisioning is appropriate now, taking a good hard look, property by property, at provisioning. So again, if you look at say the office sector, understanding that you're building in the downtown area with a very elevated vacancy rate is not miraculously going to be okay. The situation we're seeing with respect to work from home has stabilized at the level that it is. And so hope is not a strategy for provisioning. Similarly, with respect to refinancing risk, hoping that interest rates go back down to a very low level is not a strategy for dealing with refinancing risk. So just taking a very cold, hard, risk-based look, property by property, and say, what is my vacancy rate? What is my repricing risk? If I look out and I see that I'm not going to get the coverage that I expect in the future, mark it down. Like take the hit. And it's really important that provisioning be done that way in just a brutally honest way. We've seen examples, you all seen examples in how the market can react if they believe a bank has not taken appropriate provisioning in advance. So that's really what I meant.
Sure.
Vice Chair Barr, on a very different subject, the proposed reduction in debit card interchange under Reg II is of concern to the industry, who I think most of us fear unintended consequences, our ability to continue to provide products like free checking to lower deposit customers, et cetera. And we worry about the data that's behind this. Do you have any perspective you can share on, why now? Why is the Fed compelled to look at this now? Thank you.
Thank you. It's a great question. So the debit charge interchange rule is a rule that has always been very controversial. It's not something the Federal Reserve normally does, but Congress gave us a very specific direction. Congress said that we should establish a rule that sets a cap for banks over 15 billion in size, that they have a debit card interchange fee that is reasonable and proportional to specified costs that Congress laid out in the statute. And we collect data every other year from supervised institutions that showed us that the costs associated with debit cards had changed significantly. And our rule was, in our judgment, no longer meeting the statutory test of having the cap on fees be reasonable and proportional to these specified costs. So we felt we needed to issue a proposal on that. As Emily was talking about before, we follow the normal notice and comment rulemaking. So we issued a proposal. We had a comment period. We extended the comment period. Commenters wanted additional data. We provided additional data. And then people came back and commented on the rule. We got lots of good substantive comment on the proposal. We're working our way through that substance. We want to make sure that we get it right, that we follow the mandate Congress gave to us. And no matter what we do, there are going to be people who are unhappy with it on the merchant side or the bank side. We understand that there's no way to issue either the old rule or a new rule that will make people happy. But we do have this congressional requirement, and we feel like we need to meet it.
Just a question on maybe coming out of the 2023 scenario. Just a question, do you think that interest rate risk stress scenarios still are a little bit biased towards a rate down scenario? So does it create a bias or a majority of focus to protect against a down rate scenario, whereas like the commercial real estate and other situations you referenced are sort of a function of a stable, elevated rate scenario?
It's a great question. I'm not sure everybody could hear, but the question is about basically measuring interest rate risk and whether current measures, banks are too focused on rates going down and not enough on rates going up or staying where they are. I think it's really important that interest rate risk testing, that internal liquidity stress testing and interest rate risk testing are exploring lots of different potential outcomes, both downside outcomes and upside outcomes in terms of the rate environment, and looking at different ways that the yield curve might change as well. And making sure that your risk modeling approaches are not artificially capped, and that your risk tolerances are appropriately being measured. And as I said in the other context, measured and managed and communicated to the board. So we've seen instances where banks really did not have good interest rate risk management. Part of that had to do with the way in which institutions did not test across the range of plausible outcomes. And obviously the interest rate environment we're in now is a very different environment from the environment we were in just a few years ago. And so making sure that your interest rate risk management practices, data modeling, all keep up with that different environment, I think is absolutely critical. And we want banks to be able to test, on all sides. We are, as part of the exploratory non-binding scenarios in the stress test, we are exploring for large banks this year a funding shock, which is one way to do this kind of testing. I think your
Great,
audience has gotten shy.
I've got one over here. I think she's moved. Yeah, go for it.
Just thank you for being here, by the way. We really appreciate it and having this opportunity. if there's any chance you could give us some more color on the Basel III endgame, kind of, will those come back again as proposed rules? Is there any timeline for final rule? I mean, any color on that would be really helpful.
Yeah, it's a great question. So right now we're working our way through the substance. So we got lots of deep substantive comments. I'm working with my colleagues at the FDIC and the OCC, as well as with my board members, to see where we want to land on the substance. And once we figure out where we're going to land on the substance, we're going to turn to the question of what the right process is from here. We just aren't ready to do that yet. And I don't know what process we're going to use till we land on the substance.
I think we have time for one or two more questions. Yep.
Quick, but do you see the BTFP, as you referenced, was sort of that 1 year opportunity or term, and then so that's going to mature over the next year, right? Just curious if we're anticipating sort of any transition that causes for the bank sector basically to manage that liquidity that's kind of provided by that.
Yeah, so it's a great question. So we are very focused on banks' liability structure, broadly speaking, very focused on that set of questions. And for institutions that have borrowed from the BTFP, we expect banks to be working now on what their transition plan is from exiting from the BTFP when loans need to mature. Those loans mature at different points. We have some institutions that borrowed very almost to the end of the new loan part of the program, and so those loans will mature in March of next year. We have other institutions all the way across, and our expectation as supervisors is that banks are thinking about what their replacement funding will be, that they're planning for that replacement funding now, that they're taking steps to be sure that their individual transition is accomplished in a smooth way. And so supervisors are in communication with banks about that now. I don't expect there'll be any one particular moment where this is an issue. It'll be an issue kind of bank by bank as their need for funding arises.
We've gotten really positive feedback on the BTFP program, I think, in general, and how it worked, at least within our district. And I see some head nodding in the audience too. I think that was something that really helped in providing liquidity, and also, as you mentioned, now it's more orderly of how to unwind from that. Sure.
Perhaps to wrap up with a forward-looking question, we're beginning to see a pickup in consolidation among the industry, including a few larger deals among the regional bank organizations. Do you mind sharing perspective on how does the Fed view this? Are you considering any changes to your application approval process, especially those where you might have one objection letter from a serial objector? How do you think about this?
We're looking at our processes together with the FDIC, OCC, and the Department of Justice. I don't think you'll see us make changes on our own. If we make changes, it would be jointly with the other agencies and with DOJ. In terms of the process overall, I think that mergers and acquisitions are a sign of any healthy industry. I expect to see that in the banking sector as you would in any other sector. When we're evaluating those applications, we follow our statutory factors. So we're looking at convenience and needs of the community. We're looking at financial and managerial capacity to execute. We're looking at the competitive effect of the proposal. We're looking at financial stability. So we follow those statutory rules. I think we have in place a system that for the most part, for most mergers, is not that painful. For the median merger application, in the Federal Reserve System takes under 60 days to process. I think we're at 50 something this year, median days to process. But we do have applications that are more complicated, more complex, or where the bank has not provided sufficient information for us to be able to act on the application, and those take longer. And they can take a very long time. And sometimes they're denied because of one of the underlying issues is not been appropriately addressed by the applicants, or they're withdrawn for that set of reasons. And I think you want us to have a searching process that makes sure that the deal is one that meets the statutory factors, and that's what we do. So we've approved. There's a lot of rhetoric out there, but we've actually approved a lot of mergers and applications over the last 2 years, including at least one very, very big one.
We've all seen the proliferation of the non-bank lenders and private credit. And those institutions are typically doing loans that are not suitable for the banking industry, riskier transactions, but they typically are getting some kind of leverage from banks. So, with haircuts against the collateral and all that. But I'm just curious if the Fed is reviewing that. Is that something that could be some kind of big risk issue for the insured depositories in the room?
We are taking a careful look at private credit. Depends a little bit how you define it, but private credit as sort of the class that people put together is largely associated today with the private equity industry and working alongside it largely in leverage buyout deals. But there is some competition with the broadly based syndicated loan market as well. That market is about 1.7 trillion today. About 1.1 trillion of that is in the U.S. As I said, most of that 1.1 trillion are these leverage buyout deals. The structure of the funds themselves, they tend to be not highly levered. The deals are very highly levered, but the funds themselves tend not to be highly levered. And the structure of those funds are today closed-end funds. So there's very little run risk. Your investor is locked in, usually not only to the equity that's in the fund, but also to the dry powder that comes from additional calls. And so in that sense, today doesn't pose heightened financial stability risks. But we are watching it very carefully, and if we were to see increases in leverage or increasing, as you pointed out, banks are lenders to these funds, increasing interconnections, or if we were to see structures that presented run risk like an open-end fund, then the risk would be higher and we'd be more worried.
Sorry, if I could ask one more question related to the M&A. When you think about how banks maybe haven't kept up with the changing side and graduated expectations of the growth of the firm, so would there be sort of a different analysis if an M&A opportunity or an application took the firm over 100 billion or took you just to that next level?
Yes, it could. I mean, what we'd want to see if we saw an institution that would need to meet higher standards, we'd expect that their risk management practices, as part of their submission, reflected the fact that they would need to meet this higher standard. So we would want institutions to be thinking in advance of a merger, not after the merger. Thinking in advance of the merger, what risk management practices would need to improve for them to be able to be effective in managing the risks of that institution.
And really include that in your application.
Absolutely.
I'll ask one more bite at the interchange apple, if I may. I appreciate that your weighing the comments from a substantive perspective, and it's probably too early, but I'm curious if you have any early read or view in the sense that reasonable and proportional to the cost is wildly different for the biggest issuers in the country versus most of the people in this room, and whether there should be a bifurcated approach taking into account the different cost structure.
Thanks for the question. I don't have an early read on that. We did receive comments about differentiating by size, even within the approach that Congress laid out, separating the small issuers from the large issuers. Could we separate the medium issuers from the large issuers? We also got comments about the particular test we used and whether it was set at the right level of recovery. So you have to pick a percentage recovery for the sector as a whole. Did we pick the right percentage that approached the right approach to do? We got comments about inputs into the cost. Could we consider other costs than the ones that were in the proposal? We got comments about the data, which is just the data we get from all of you, but comments about whether the data is accurate. And we're weighing all of those comments. We take them very seriously. I feel like this is like when I'm in the classroom.
Right.
And you have to be, as a professor, you have to be
while.
really patient.
You do.
And just wait the students out.
Yep.
And eventually
there's this level of uncomfortable
one
silence.
of them, one of
Mhm.
them gets
Still
so
fine.
uncomfortable about the silence that they'll just answer.
And it worked.
Yeah.
So as a professor of law, do you want to handicap the prospects for CRA modernization now tied up in the courts? I want to commend the Fed and the other regulators for a reasonable effort to take a facilities-based statute and try to make it adjust it for the environment we live in today. But there are some potential weaknesses, I think, in that one.
Well, let me say it is my long-standing practice and the long-standing practice of the board not to comment on litigation. So I will not accept your invitation. But I will say, I think, just apart from the litigation, that I think that the CRA modernization is a real opportunity to help communities and to help banks, to provide greater certainty to both banks and communities about how to get various kinds of grades, provide greater certainty about what activity counts and contributes towards a positive score. The rule updates CRA to reflect the world that we all live in banking today. So I think that the rule is a rule that is both lawful and appropriate to advancing the interests of banks and communities in better serving communities around the country. And I say all that not commenting on the litigation.
Thank you for that. And I think we've covered a lot of ground today. We've gone over sort of liquidity and your views on capital. Thank you so much for the candid conversations you've had about the rulemaking process. And we've heard from our bankers on a variety of different topics, be it the debit interchange, and also a lot of questions on mergers and acquisitions. So this has been a really helpful discussion for all of us here today. I want to thank Vice Chair Barr for his time and for coming to Dallas to be a part of our conference. So if everyone can please give me a round of applause. Appreciate it. And so with that, we will conclude our live stream. And I believe I can look to those in the back to tell me if that